U.S. stock futures pushing higher this morning following the May jobs report. Strategists are increasingly bullish on Wall Street, with several lifting their S&P 500 forecasts over the course of this week. So what can we expect for stocks in the second half of this year? Joining us now with more, we've got Kate Moore, Citi Wealth's Chief Investment Officer. Kate, it's wonderful to have you in studio.
Yeah,
thank you for joining
us.
And congratulations on the new role as well. Talk to me about how you are thinking about stocks in the second half of this year, and can the rally that we're seeing kicking off this morning continue?
Yeah, look, so I grew up with stocks in my DNA, right? You know, this is how I really love to take risk. Unfortunately, I'm not as optimistic as some of the market pricing kind of would now suggest. So let me put it this way. I think there are a number of significant headwinds in the second half of this year that are not being reflected in risk asset prices. And people are afraid to miss a rally if there is one. So they're not positioned, frankly, for some of the weaker news and perhaps some of these headwinds on earnings, on macro, on tariffs, on policy, even if they discuss them. I prefer to stay up in quality in the equity market, so that means a bias towards large caps, mega caps that can earn through all parts of the cycle. And I prefer to stay really anchored outside of the US to countries and markets where I think there could be fiscal stimulus and policy support.
Where are those countries?
You know, we see some areas of Europe. I mean, everyone's gotten themselves very excited about Germany, for example. Also, we have to recognize that spend mostly comes in the second half of 2026. But there's perhaps scope for additional fiscal stimulus on the margin in some European countries. I also think there's more scope, frankly, for stimulus in China. We've had some kind of deflationary pressures. Some of the demand hasn't looked great. That said, we know the government wants to continue to support the market, and they have the scope on both the monetary and the fiscal side if the tariff headwinds end up becoming a real issue in the next couple quarters.
How do you think about which wins out? Fiscal stimulus that drives those global economies you talked about versus U.S. large cap tech that has continued to dominate for the past few decades?
Yeah, look, you know, we have a concentration, of course, in U.S. large cap, which I think makes a lot of sense from the quality bias I was mentioning. But on the margin, one of the trades we did in our portfolios this week was to add a little bit more to the European equities and to China on this kind of stimulus support, as well as perhaps a flows support, which I didn't mention just a moment ago. You know, this idea around whether or not the U.S. should be exceptional in everyone's portfolios, or if it should be the most, that very large overweight that many people had allowed it to become, both from drift and additional ads over the last couple of years, I think is very front and center of mind for allocators. Incrementally, they may put more money outside of the U.S.
What's the risk of kind of nationalist consumerism also trickling into investor mindsets as well?
Yeah, I mean, that's a really good question. It's something we're debating, but I don't know if we've seen any data suggesting any significant move as of now. But there are a couple things outside of just, say, you know, kind of the consumer activity. You know, big asset allocators, big institutional investors are having this discussion: how big should one country be in my portfolio if it's not my home country? But they don't make these moves at the start of the discussion. As you know, these are slow-moving reallocations. They happen over a series of quarters, sometimes at an annual or a semi-annual rebalance. And I expect we're going to see this happen in shifts, basically, over the course of the next year or two.
It just seems like one of the initial places that starts to show up is actually in the bond markets if you do have weak auctions than anticipated here.
Yeah, for sure. And the auctions, especially in the long end, are really something we're going to be laser focused on. Look, so far the auctions have gone well, but the fiscal picture in the U.S. is deteriorating. And there may be better international bond markets to allocate additional capital to. And we're kind of looking at that as well. I mean, I think we have a pretty consensus view on bonds. We've been short duration. We've held a little bit of cash. I added a little bit of gold to the portfolios this week. All of that stuff is supportive. But we are not sure at what level we would add to long duration fixed income. And frankly, it's not just us, it's every global investor who's doing that same questioning.
And what is the biggest thing that would have to change to get you to reconsider the longer end of the curve?
Well, I guess it's not just the level, right? It's not like saying, oh, at 5% on the 10-year we'd want to add. It's more like, how did we get there? And what is the speed at which we got there? You know, if we got there because we all of a sudden have a great view on growth for the next couple years or the medium part of the cycle, awesome. If we get there because the fiscal situation in the U.S. continues to deteriorate and we don't really have faith in the U.S. government in the way that we might have had decades ago, that's not great. So it's not just the level, it's how we got there and how fast.
How long can one basket of companies in the Mag 7 continue to be the shining light or the North Star for the markets to just take their cues and for investors to take the cue from.
Yeah, look, I get it. Everyone is uncomfortable with the leadership and the concentration. But what I will say is these are companies that continue to put up earnings, that have very, very strong free cash flow profiles, have strong management teams, are working in the most interesting and fastest growing parts of the market and the economy. So it's not like they are leading for no reason. Mm-hmm. And by the way, I would suggest there are lots of parts of the tech complex that are not in the Mag 7, mm-hmm. parts of like high quality consumer, things in the infrastructure space that are leading as well, that have those same profiles. Great management teams, high free cash flow, and frankly, are in kind of more secular spending themes.
Can you, and we've got about 30 seconds left, but can you talk a little bit about the declines in the dollar and if you're worried about that impacting US stocks?
I think it can, on the margin, have some impact. Everyone started this year agreeing that the dollar was relatively overvalued. Yeah. But I think we're going to see fits and starts, a little bit of a decline and some stabilization. The dollar's not going to lose its reserve currency status, in my view, in the very near term. That said, as we're talking about portfolio reallocations, I think how much people want to own in dollars is going to become to question. And a lot of our clients are hedging their US dollar exposure, especially our big global clients.